The interest gained on advances and investments is the bank's major source of income. Interest accrues on a periodic basis, but if the borrower does not pay interest within a specific period, the bank has to reverse this accrual. Thus, the loan becomes a non-performing asset, NPA. NPAs eventually lead to defaults and losses to the bank, and banks need to make provisions for such losses. In this unit, you will learn about classification of assets, conditions for the classification of NPAs, the principle of recognition of income, provisioning norms for different categories of assets.
The Committee on the Financial System, chaired by N. Narasimhan, developed the asset classification norms in India in 1991. This committee was set up to develop standard norms so that all the banks could use a uniform set of accounting practices. This has made it easier for all the banks to account for income recognition and losses in debt. Asset classification based on the objective assessment of assets is the cornerstone for accounting revenue recognition and debt provisioning. Therefore, the classification of a loan into a performing or non-performing asset is very important. An asset, including a leased asset, becomes non-performing when it stops generating income for the bank. Based on the RBI's guidelines, any loan or advance where the interest of principal is not paid within the period of 90 days with respect to term loans is a non-performing asset or NPA. Therefore, an NPA is a loan or an advance where interest or installment of principal remains overdue for more than 90 days. The account remains out of order for overdraft or cash credit facilities. The bill remains overdue for more than 90 days in the case of bills purchased and discounted. In the case of agricultural loans, the installment of principal or interest remains overdue for more than one crop duration for long duration crops and 2 crop durations for short duration crops. Banks should classify an account as an NPA only if the interest charged during any quarter is not serviced fully within 90 days from the end of the quarter. The following examples illustrate the concept of NPA categorization better. NPAs are classified under 3 categories. Click each button to learn more. The following important factors should be considered for classifying assets as NPAs. Balance sheet dates should be examined critically in accounts where only a few credits are recorded. If the latest data indicates financial weakness, then they should be classified as non-performing. Otherwise, the bank should provide reasonable justification to auditors for not classifying them as NPAs. Asset classification should be done borrower-wise and not facility-wise, as credit quality depends on the borrower and not on one facility. Asset classification of accounts under consortium banking should be based on the record of recovery of the individual member banks. Advances against term deposits like National Savings Certificates NSCs, Kisan Vikas Patra KVP and Indira Vikas Patra IVP need not be treated as NPAs. In certain cases, there may be a moratorium in interest payment. For example, loans given to industries under certain schemes. Such assets can be classified as non-performing only after moratorium period ends. The classification of an asset as an NPA should be based on the record of recovery. The bank should not classify an advance account as an NPA merely due to some temporary deficiencies, such as non-availability of adequate drawing power and non-submission of stock statements. In the case of loan accounts classified as NPAs, if the borrower pays the arrears of interest and principal, then the account should no longer be treated as non-performing and may be classified as a standard account. The policy of income recognition is based on the recovery of payments. Interest on advances against term deposits, National Savings Certificates NSCs, Kisan Vikas Patras KVPs, Indira Vikas Patras IVPs and life policies are taken into the income account on the due date provided adequate margin is available in the accounts. Income from an NPA is booked as an income only when it is actually received in cash. Therefore, banks should not consider the interest on any NPAs as income. Fees and commissions earned by the banks because of regulations or rescheduling of outstanding debts should be recognized on an accrual basis. In the case of government guarantees, advances become NPAs and the interest on such advances should not be taken into the income account unless the interest has been realized. For security converted for equity, if the interest due is also converted into equity, then it should be recognized and valued lower than the market value or book value of the equity. If interest is not converted into equity, then provisioning should be made for the same. At the close of a financial year, any advance such as bills purchased and discounted may turn into an NPA. In such a case, the interest that was accrued on that asset and credited in the corresponding previous asset is reversed if it is not realized. This applies to government guarantee as well. With respect to NPAs, fees, commissions, and similar income that have accrued should cease to accrue in the current period. If uncollected, they should be reversed or provided for with respect to past periods. The bank ceases to earn interest on NPAs and thus is deprived of its legitimate income from the asset. The bank is also required to make provisions for this asset depending on the category of the asset and the value of security, if any. This makes a further dent in the profitability of the bank. The RBI introduced the system of asset classification and provisioning in line with international practices in 1993. Provisioning should be made based on the following classification of NPAs in the event of non-recovery. Click each tab to learn more. As you study the subject, it will help to pause and check your understanding. Here is an exercise that will help you to do that. Read the instructions on the screen to complete the exercise. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. In this unit, you have learnt the following. In the year 1991, the Narasimham Committee was established to standardize asset classification norms, and the RBI adopted the suggestions of this committee. An asset is classified as an NPA based on the criteria of non-recovery of interest within the specified time limit, 90 days in case of a loan or advance. Different categories of NPAs have different provisioning norms with a maximum of 100% provisioning. For NPAs, revenue can be recognized only on cash basis. Recognized revenue that has not been realized should never be reversed. You have now come to the end of this unit. Answer these questions to see how much you know about the concepts you have covered in this unit. Go through the unit again in case you have doubts.